let's get in a little more detail into mergers and acquisitions. This is a presentation I was going to update this year, but because I don't have access on campus to the Bloomberg machines, I can't update it. It's still not out of date. Everything in here is current except for some of the bigger mergers and acquisitions that have happened recently. So the text, the concepts are all correct. I'm going to skip through a few of these quickly because I don't think they're really critical issues for you to understand. If you're a finance major, an accounting major, this might be an area you want to get in more detail in, and then you can definitely study it more. I'll give you some ideas as we go, some areas you can do additional study and research if you're interested. This is the area if you are interested in investment banking. This is what investment bankers do. If you're a technology major or marketing, you just be aware that mergers and acquisitions are having huge impacts on companies and industries. So it's something probably most of you will have to deal with. So some of these issues are good to know and be aware of, but I will skip through some of them a little bit quickly just because you're better off researching on your own, because there's a lot of detail, a lot of intricacies to mergers and acquisitions that boy, you could spend an entire class. There's graduate programs that spend 1 or 2 semesters just on mergers and acquisitions. So give you a little bit of a history, and then some of this we talked in last class. What are the motivations? Why do people do M&A? So that'd be a little bit of repetitive. Who are the participants? What do regulators think? And then on this last part is where I'm going to skip through more quickly and let you research on your own end what some of these terms mean. So that's, and then we talked a bit about valuation. Valuation with mergers and acquisitions is really not any different than what we're going to talk about with valuation. We do stocks and bonds. And then on the end, the very last part of this presentation, structuring, alternative strategies, and international issues. I'll click through those pretty quickly. If you're an international business major, the cross-border mergers and acquisitions are a huge issue. So we'll talk on a few of these. So just a little bit of history. The motivation for mergers and acquisitions, we talked a little bit before about it's a way to replace bad management. And so the fact that a merger and acquisition can take place is a way for the board to hold management accountable, and it's a way for the stockholders to hold the board and management accountable. So the stock market is essentially a grading system for management and boards. And so the purpose of merger and acquisition is make sure we have a good, efficient allocation of our economic resources. Mitt Romney took quite a bit of heat for working for Bain Capital when he's running for president. Bain Capital definitely did mergers and acquisitions where a lot of people lost their job. You can argue that that's good for the society, because if you have a business that has 40,000 employees and that business can run just as effectively with 30,000, it's true that 10,000 people lose their jobs, but that company's products are cheaper, stockholders make more money, and so the fact that people are spending less for a product, stockholders are making more, that gives us more money to invest in other businesses. So M&A might have people laid off from their jobs and lose their jobs, but it also creates new jobs because it more efficiently allocates our country's resources. But there's debate about that. You can certainly look at the good and the bad side of M&A. So it is a resource allocation tool. It puts stress on management to make sure they're doing what is right for the stockholders. Here's a quote from 3 gentlemen who wrote a book. The corporate takeover market acts as a court of last resort to discipline inappropriate management behavior. So you always have this threat. If the firm is not being managed well, someone can come in and merge with that firm or acquire that firm, fix the problems with management, usually let go of management and hire new management. There's a history here recently. Obviously, things have changed quite dramatically. So we had the dot-com bust coming out of the 1990s that definitely put a stop to M&A activity. Globalization is a big issue. A lot of focus on productivity, technology, and innovation. So One of the problems I have with mergers and acquisitions is that firms like Alphabet and Facebook and Apple tend to do acquisitions just to get rid of competition. So it may actually be harming innovation, but that's a big debate, and it's one we'll see more and more going forward. The 2008 crisis definitely had a huge impact. M&A activity dropped off quite dramatically after that. Now our issue coming forward is sovereign debt. Countries have so much debt. Are we going into a debt crisis? So the coronavirus is certainly exposing some of those issues, and we'll see. Um, Governments are more and more moving toward deregulation, although we're seeing in Europe and even in the U.S. some a little bit more government involvement in what they call strategic assets. Governments trying to protect companies like Boeing, trying to protect what they call strategic industries, using security of the nation as a reason not to allow mergers and acquisitions to go on. There has been some debate that we've recently in the pharmaceutical industry. There's been mergers and acquisitions entirely driven for tax reasons, and that has been essentially shut down in Europe, not to allow firms to do that. So it's the governments definitely are getting more involved, and we're seeing this in the last Democratic debate. I'm doing this video the day that Sanders dropped out the presidential race, but definitely Sanders and Elizabeth Warren, were talking about breaking up companies, breaking up Facebook, breaking up big banks, going the opposite of M&A to kind of unmerge, unacquire companies and make them smaller. Here's some history through 2011. You can see the U.S. is essentially 50%. I know North America includes Canada, but still the U.S. dominates this. Europe has actually been shrinking during this time. Europe is going through a really rough time here. This is during the European crisis with what was going on with Hungary and some other countries, and Spain and Italy. They're still struggling, so their M&A activity has been a little bit weaker. Here, what you're seeing is a big increase in countries like China. In fact, you can see it here. Eastern Europe was a big growth, but you're seeing definitely growth in Asia. Asia's been a good growth area. So these are growth rates. This isn't the percentage, but this just show you where growth is. Eastern Europe was really interesting. There was a mergers and acquisition manager came to talk to me about Eastern Europe in particular, and the advantage they have is very similar culture to Europe, similar languages, but the opportunity for a lot of growth because it was very undeveloped countries coming out of communism, and so there's a lot of M&A there, and you're still seeing that here recently. I've seen some articles coming out of 2019 and 2020 where there's still some incredible opportunities in just Eastern Europe. Obviously, opportunities in Asia. North America, not high growth rate, but you have a huge base, so it's hard to grow up much. Western Europe is where you're seeing probably the most weakness. Latin America, it's kind of hit or miss. We're seeing a lot of political upheaval in Latin America, obviously in Brazil and Venezuela and Argentina, even Chile and Peru, countries that are seeing some political strife, or at least a lot of political activity. Ecuador, man, my word, a lot of Latin America are seeing issues there, so it's making investors nervous. So that activity has been a little bit volatile here recently. Here's some, boy, I wish I could this is one I would love to be able to update, but just looking at some major M&A activity in the past, some of them have been disasters. Obviously, AOL and Time Warner has not been a great one. ExxonMobil was a fairly important, impressive merger. You're seeing some other one in the energy market. You're seeing pharmaceuticals. AT&T keeps, it's interesting. In 1980, we broke AT&T up into a bunch of companies, and here recently, AT&T is essentially rebuying a lot of the companies that they spun off. You're seeing some in the financial services. This particular transaction has not gone as well as Citicorp would have liked, and so it's there's some of these that work better than others. I'll have to, boy, maybe if I can get the Bloomberg, I'll update this, and maybe you can tell you. I doubt I can get the Bloomberg and show you some of these really huge transactions we've been seeing here recently. Right, motives, we talked about this. Synergy is the main thing. Vertical synergy, where you either buy a supplier or you buy a customer. Horizontal is you buy one of your competitors. That's where the regulators get the most worried. And then you just have conglomerates, which that's the Boston Consulting Group, is you just want to buy a bunch of companies so your firm is diversified. The stock market does not like that because it makes firms very, very difficult to analyze. They're too complex. Financial synergy is, there's some of that having to do with getting better cost of capital. Diversification is similar to the conglomerate. We really don't like that in finance because stockholders can diversify themselves. They don't need management doing these expensive transactions to do that. There might be some strategy to realign for a distribution system or something along that. But a lot of evidence is out there that the main driving force behind M&A is just arrogance of management. CEOs want bigger firms. You might do M&A to buy, if you have a firm that just has undervalued assets, you might do some M&A activity. There was some with Sears in that sense, that Sears stores were not making much money, but a lot of the stores were sitting on really valuable real estate, so that was an incentive to buy out the firm. Address mismanagement, managerialism, which is managerialism, which is similar to that. Mismanagement is taking advantage of management in place. Tax consideration, that's where we're talking about the pharmaceuticals. They have huge tax benefits from merging between different countries. And then the last one, which the regulators really do not like, is market power. You have too much power in a few hands, and so you can increase power, you increase prices because you have monopoly or oligopoly power. Those are dangerous from a regulatory standpoint. Where does the value come? What are those synergies? You have assets that the firm has that aren't on the balance sheet, some maybe brand identity or some patent. Platform right now is a huge issue. We might talk a little bit about platform, but firms like Facebook and Google, even Amazon a little bit, not quite as much, but firms that have this first mover advantage where they have, Uber and Lyft are examples. They have huge advantage because of their size, because they're so big. People tend to go to them first because they trust them. They know they're going to get a lot of competitive, there's going to be a lot of drivers if you're in Uber, and Uber drivers like to go to Uber because they know they get a lot of customers. We talked about how adding debt can reduce your cost of capital. You see a firm that's not using its debt capacity correctly, you buy them out, and that reduces your cost of capital. Taking advantage of that tax benefit of debt. You have some intellectual process or something that can benefit your firm, and both firms can benefit, so you buy the firm. Two new technologies, new processes. Damodaran in his class, and if you're a finance major, definitely email me if you want to see the link to Damodaran's class and get my notes from his class where he talks about M&A. He says the most effective M&A is, I don't really have it up here, but it's the synergy part, and the most effective M&A has been to reduce expenses. The least effective have been trying to get market power or increase revenues or get diversification. Those tend not to work as well. Firms tend not to get all the customers they thought they were going to get combining the two firms. So you can destroy value if you have bad product quality, compensation versus the industry, poorly written contracts, environmental issues, that's a big issue today, major lawsuits that you're worried about. We saw this in the 2008 crisis with firms like Lehman Brothers and Morgan Stanley, where they had assets on their books that were just going to blow up and people were worried about them. Who are the participants here? You have investment bankers, so this is very much an investment banking field. If you want to do this, if you love looking at businesses, analyzing businesses, valuing business, and then you want to be in control to go in and say, hey, let's merge these two firms, let's replace management, let's spin off this company. Boy, they're high-paying jobs, they're stressful jobs, but you learn a lot about an industry. You become an expert, very, very deep expert. and it gives your resume a boost that you'll probably have no trouble finding high-paying jobs the rest of your life. But just realize they're time-consuming, they're very long hours, and they're stressful jobs. Lawyers, I do have some finance majors who've gone on and gotten their law degree, and the M&A area is a very lucrative area. People with finance degrees and their law degree. Accountants are involved, making sure that the combined firm, that those numbers are accurate, all the information is correct. You have firms out there that are helping with the proxy fight. Who's going to vote? Are you going to vote to do the M&A? Are you going to vote against it? You have a public relations part of this to help sell investors on what's in the best interest of them as investors. Institutional investors tend to be the biggest players on the investment side. Retail investors tend not to get too involved in this. When I was an investor on the institutional side, we got proxy statements all the time. We would review them. We wouldn't review all of them. Some of them we outsourced to a proxy firm, but usually mergers and acquisitions were the ones we would review the most closely. So yeah, finance majors, investment banking is something you should look into if you like the complexity of certain industries and really getting into the big deals, lucrative deals. Regulators, regulators can definitely put a stop to mergers and acquisitions. You saw that especially with Donald Trump and his dislike of CNN and some of the things he did to try. It's a little different world today in Europe. There's concerns about too much power in these big technology firms. You've seen Facebook having to go before Congress and justify their size and power. So that's become a bigger issue, antitrust. We've seen a few mergers that have been prevented based on national security. There are some firms that handle big defense contracts. Obviously, we're really worried about the U.S. expressed concern about Huawei and China, and is China creating software that's going to allow firms to Huawei to spy on firms and get secrets? All that's a big debate. Environmental concerns have been a bigger issue in some of these mergers and acquisitions. There's definitely been some fraud and illegal activity. And how are employees going to be treated? That's been some of the consideration. So regulators getting more involved. We do have legislation that affects this, the Security Acts. Then we do have antitrust acts like the Sherman Act. Surely you've heard about this in some of your previous classes. If you don't know the Herford Index, I would look it up and make sure you know it. It's one of those things most business majors should know. It's a really simple ratio. You can look it up on Wikipedia. Essentially what it does is it takes the market value of all the firms in the industry and takes that market value and squares it. So if you have 25% of the industry, it takes 25 and squares it. If you have 1% of the industry, it takes 1 and squares it. So if the industry is pretty well diversified, no one has more than 2 or 3% of the market share, then the Herford Index would be very, very low. But if you have some big players that have 30, 40%, when you square a big number, you get a huge number. And so the Herford Index is still used today. Regulators still use it. So it is a good approach to figure out if industry is concentrated. This is something that you could look at if you have in your capstone class. You're looking at a merger acquisition type of deal. You could certainly go on the Bloomberg and get all the revenue for the firms in that industry and run the Herford Index. I've done that before. It's not a hard index to run. Your professor would be really impressed if you brought that level of analysis into your project. All right, M&A tactics, just real quickly, you can look these up on your own, but there are friendly takeovers and then there are hostile takeovers. Friendly takeovers is when the two firms, they agree, they want to do it, it makes a lot of sense. Both boards are in agreement, it's just a matter of how to work it all out. Aggressive takeovers is one firm is essentially trying to out the management of another firm, change its management, change its board. That management's going to be fighting hard not to let that happen, and it's going to be a battle, and you end up with a proxy contest where the takeover firm, the firm that's trying to do the takeover, is going to try to convince stockholders to vote yes, and management's going to try to get them to vote no. How does management defend itself? Again, I'm not going to go through these. You can look them up. If you're a finance major, you should probably know what these are, although I think most people probably have to look these up if they don't deal with this every day. But you have defenses that try to protect you before someone does an M&A activity. Poison pills, shark repellents, golden parachutes have really strange names. You can Google all this stuff and get the titles. I get them a little confused myself, so I get between them which one is which. So it's not an area I know on the back, just off the top of my head. Post-bid defenses, so someone's made a bid for your company. What can you do? Green mail, white knights. You try to get another firm to come in and buy you out, and there's others. There's many, many more. If you're in this area, if you're interviewing with an investment bank, definitely got to learn these terms before you go into your interview. But it's easy to do. They're out there on Wikipedia and not very difficult to find. Valuation, we'll start with valuation on the next one. You're going to find the valuation. I'm going to skip through it fairly quickly, mainly because valuation is an area where we're going to cover when we talk about valuing stocks and bonds. So it's going to be an area we're going to cover later in the class, to be sure. So I don't want to cover it twice here in any other place. I just wrote this will be a good introduction to the valuation we're going to do in a couple of weeks. So I'll use it more as an introduction. But it's good to note that if you're buying stocks like Facebook and Apple and Walmart, the valuation process you do to figure out if you want to buy a stock, it's the same valuation process that investment banks do when they're trying to do mergers and acquisitions. So that's the good thing. You don't have to learn a whole lot of new stuff. There are very specific valuation models that mergers and acquisition investment banks use. I'm not going to show those to you, but if you're a finance major and you're interested in this, I can certainly get you your hands on those models. So before you do an interview, you have some intimate knowledge of a typical M&A valuation model. So I'll stop it there, and then we'll finish this up in the next session for this class.